Good morning, guys. I'm just testing out mic audio real quick. We will get started shortly, though. Should be a big day, a lot of volatility potentially. I just have the stream unlisted, so I had to change that to public. So hopefully you guys can all hop in here. I got 30 minutes until I am going to be starting. But yeah, just testing audio right now. See you guys in a bit. Good morning, Mickey. I'm also ready for the action. If you guys want something to watch, there's a almost 1,000 Bitcoin sell wall that we're coming into right now here on price. You can see 750 Bitcoin just about, and it is currently kind of getting filled here by this price action. So that's something to keep track of. I'm going to go to the 5-minute candles, so it's a bit more exciting to watch here. Just on the background, this is like the live order flow behind the countdown, so you guys can have something to watch instead of just looking at a countdown. If you do want to chill in the stream before I get started. But yeah, see you guys in a bit. Evil Twin says, if you're here right now, you'll be rich soon. Hopefully so. Welcome to the stream, Filthy Rabbit. They might raise 200 basis points. Hopefully not. That would signal that they're pretty worried about unemployment. I don't think that's going to happen. I think we're going to see either 25 or 50 basis points of a cut today. The markets are predicting a 50 basis point cut, or at least CME Group is. Something on the chart that we can look at, or you can look at while we're still having the countdown, is we had this big sell wall around 750, 800 Bitcoin sell wall actually got removed from the order book, so price is now accepting above it. We have another big sell wall up here around 600 Bitcoin, as you can see here in the order book on Trading Lights. So you can keep an eye on this as you continue to watch this countdown. We will get started soon. Only 10 minutes left. What's up, Mark, by the way? Alright, the numbers are about to be released. I'm going to pull this over here on the screen. Still going to have the countdown going on, but just before the countdown ends, we will be getting these numbers on what the federal funds rate is going to be. You can see right here, it's kind of small font, but 1 minute left on this. So we'll see what this comes out to. You can see forecasted 5.25. Let's see what the actual is. Is it going to be 5%, 4.75? We will see. CME is actually predicting that it will be a 50 basis point rate cut. You can see 475, 500. So CME Group has actually a different prediction than what Forex Factory is telling me. So we will see. Big day ahead of us. Don't fade CME. 50 basis points. I know a lot of people were predicting 25 basis points. Even Forex Factory was. If they cut by 50 basis points, it is now at 5%. That'd be an interesting Fed meeting that is going on in just 30 minutes. So we'll watch the meeting live together. And with that data, insta giga pump on Bitcoin here, straight through these sell walls. And those were in fact fulfilled there. You can see 600, 500. Another 500 Bitcoin fulfilled there on price. Getting a bit of a pump here. I know that the higher they cut, the worse it actually is. But while it may be more or less immediately bearish and medium-term bearish, it is a long-term bullish. And I do think it could be very immediately kind of bullish because, you know, retail euphoria, they like the cuts, and we're going into election season, so I do think it's going to be more similar to 2008, where you have a couple months of a blow off top before the actual cuts do come in, or at least more of a double top, where you do have that up thrust kind of after distribution, as we've been talking about here with Bitcoin. Let me know in the stream chat if the audio is all good. I will be reading that today throughout the stream, and let me get OBS over here and check everything out. It looks like my mic is sounding good. I tested that before during the countdown. Let me know that everything is looking good. You should see the main screen here with just trading light, and then we can also pull up trading view and go over some stuff here. Tap into this higher volume level. You can see these volume levels just play out perfectly. They're all drawn out using fixed range volume profiles. So this nice tool here is probably my favorite tool on TradingView. You can go ahead and pull ranges, and it'll show you value area low, value area high, point of control with this nice volume profile here on the charts. Let me go ahead and actually check the stream chat though. I got this pulled up on my phone. Make sure I'm getting to everyone. I will say one thing I'm not going to do today is go over altcoins. That usually drags the stream out for quite some time, and I think I'm going to do the stream instead of a normal video today. So I want to keep it concise to the price action and to any questions you have about the price action or trading, etc. You can ask me any questions you want. Just probably not going to do specifically looking at altcoins. If you really want me to look at your altcoins, super chat like $1, whatever the minimum amount is to super chat, just so you can get to the front of the line there. But yeah, I'm not going to be looking at a million altcoins today. Sorry guys, I just want to keep it fair. So if I look at some people's and not others, that seems kind of unfair because I won't be able to get to them all. All right, Variance says hi guys. Good morning, man, or good afternoon, wherever you are. Maybe even good night. How funny would it be if they increase? That would be pretty funny. That is something Jerome would do. Higher for longer. So sad. How one speech can change your life. Yeah, or it could be amazing how one speech could change your life, you know? Uh, let's spell speech correctly first. What is that in this thumbnail or something? Did I? Let's see here. Okay, no, we're talking about that comment. I thought you were talking about me for a second. I got worried. I was like, oh, hold up. Did I misspell speech in the thumbnail? No, I don't have that word in the thumbnail. What's up, Ori? Kelvin, my prediction is rates are going to get hiked instead of cut. Well, that didn't happen. They cut by 50 basis points. Uh, as long as you guys can understand what I meant, who cares about spelling? Yeah, no one cares really. Speech is speech. Rizzo time, crypto to the moon. Maybe. I think there's a good chance. We'll talk about that. So yeah, I'll keep the chat up. I read through everyone for now. Just let me know, make sure the audio is good. If anything's wrong, visuals, audio-wise, just send me a message. 50 basis point cut confirmed. Yes, that is 100% confirmed. We can see the numbers right over here. So this is CME Group. This is what they predicted. Right? 60% chance they were going to cut by 50 basis points. We go over here to Forex Factory to look at the actual numbers. You can see it was revised down to 5%. So previously, we can go here. Previously, it's been 5.5%. They've been paused for quite some time. You can see now 50 basis point cut down to 5%. What does this mean? It means that they are trying to stimulate the economy because of unemployment. We go over here to the unemployment chart. You can see it has been trending up, but we are getting a bit of a downturn here locally. So we want unemployment to continue down while they continue to do their cuts, right? As long as they're not speeding up cuts because unemployment's skyrocketing again, then we shouldn't have anything too concerning to worry about, at least in the short term. But I do think this is definitely signaling we're going to enter a recession at some point because of just how these cycles usually play out. You can see aggressive hiking cycles followed by long pausing cycles, followed by aggressive cutting cycles, signals recessions almost every time. Back in 2000, we talked about this in yesterday's video, by the way. If you missed yesterday's video, please speak up. Yeah, it's something to do with my mic. So I kind of got a new mic a couple months ago, but I unplugged it, plugged it back in, and for some reason it went down like 10 decibels. So I've been having to boost that in my audio software. So I mean, definitely just turn me up on whatever you're using, like your phone or your laptop. What I can do is probably go into these audio properties and actually boost the gain because it's already at max volume in my actual OBS, but I might be able to do over 100%. Let's try that. Let's see if that actually did anything. It's at 110% right now. I don't know. Let me know if that's a little bit better. But yeah, you can see, look over this real quickly. Once again, I talked about this in yesterday's video. So make sure to go watch that. But 2000 hiking cycle followed by aggressive cutting cycle. It's really just these aggressive cutting cycles that causes it because it shows there's something wrong in the economy. .com bubble. By the way, this is gold, S&P, and Bitcoin down below. But you can see aggressive cutting cycle was the start of the downturn into the .com bubble. Then we have 2008 aggressive hiking cycle followed by cutting cycle followed by aggressive cutting cycle here. So this is very similar to where we are right now, right? And then that was the start of the great financial crisis. Now what's interesting here is that we actually had 2 months of upwards swinging price movement there. We had a bit of a double top here on the S&P, which is very similar to what we are having right now. So we had our first peak back at around May, April, June, and then we went ahead, had a bit of a drawdown and then a rally after the cut into October before we did enter the recession during this aggressive cutting cycle. We see that we currently, I mean, we could talk at 2019 real quick too. We had a slower hiking cycle into a bit of an aggressive cutting cycle, but much lower here on the federal funds rate. And this was signaling our 2019 bear market. So the only time Bitcoin has ever seen cuts, it has been during like right after a bear market rally. So it was not bullish for Bitcoin. But after we got back down to the zero line, that's where it is bullish, right? Whenever the Fed gets back down to zero, that's usually bullish. But during the actual cuts, during this cutting cycle, is usually pretty bad for markets. But we can talk about how 2008 we had this 2 months of upward swinging price action, and it was a very similar time of the year. It was August. Right now it's September, going into election season. This was also going into that seasonal time of the year, right? The fall is usually the most bullish for markets. Sell in May and go away, buy back in before fall. Usually works pretty good. Buy back in September. We can see if we go over to the S&P 500. Well, we just shot up into all-time highs. So new all-time high on the S&P. We did swing fail it though. But you can see we are forming some sort of distribution on the weekly time frame. Could this be that double top from 2008? First high, secondary high, and then you roll over into the bear market potentially. Let me show you 2008 so you can see what I'm talking about. Or actually, it would be 2007, and it would not be on this chart because that is futures, and it does not go back that far. But if we go back to 2008, you can see we had a very similar structure here. We have the first scare right there. Then the Fed cuts in this range. We rally up, and that's where your top comes in, and we fall from there. What is Bitcoin going to do in this sort of scenario? Who knows? Bitcoin was not out in 2008, so we can't look at that historically. We can only look at 2019 when they cut, and we know that was a bear market rally finishing. So it has never been bullish for Bitcoin, but we have one data point to go off of. We only have 3 data points in the last 20 years to really go off of. This is some historical stuff going on today. Will it signal the next Great Depression, or will it signal bullishness because the economy is finally getting some relief when it comes to these high interest rates? Short-term bullish, medium long-term bearish, you think? I would say potentially short-term bullish, probably medium-term bearish, and potentially long-term bullish. So once they actually finish the cutting cycle and get it back down to the zero line where there's no interest rates, then yeah, that's normally very bullish for markets, but it takes time to work its way into the economy. The stall has a lagging effect. So I think eventually it will be bullish. But yeah, let's go ahead and jump into the Bitcoin price action. So we saw S&P here swing fail the highs. So we wanted to see that get recovered. We don't like swing failures here. That is bearish. But it's completely to be expected, right? It is FOMC day. We expect a ton of volatility here on the chart. And you can see already just insane volatility on that news. Look at the 1 minute candle here on the S&P 500. Sending up an entire 1%, which 1% you're going to think, well, it's nothing. But for the S&P, that's a massive move, especially in a 1 minute candle. That's crazy. We jump back over here to Bitcoin. We can see this is a little bit less volatile immediately, but go to here to the 1 minute. You can see very similar thing. Just mooned on that 1 minute candle, filled a lot of these short positions and did reject them. So yeah, immediately this is looking more bearish, but it's nothing too concerning, I would say, immediately. We'll see what happens though, right? These moves can really fake a lot of people out. We could see, since we already got the pump and dump, we probably see a bit more of a dump. And then we see a fake out to the downside. Maybe the first move is the fake out. So we see first move is fake out, come all the way down here. This is a big level I'm watching because this is liquidity, right? There's a lot of poor lows within here. So we come down to like 56,600, and then we rip from there, maybe on some sort of hourly 4-hour bull div coming in here. So we'll see how that does play out, right? Would not be surprised. First move fake out and then launch up. We got 20 minutes until that meeting, so we will expect some volatility during that Fed meeting, depending on what they say. Jerome has been very unclear of what he wants to do previously, but now that they actually have made a decision, I think he has to speak up and actually give some points as to why they cut. So that'll be really interesting to see his take on it. Let's talk about the levels. So I would have mentioned this in yesterday's video, but it wasn't really about the price action. It was just about the Fed, FOMC, talking about what we would expect to happen there. We had these highs within the chart that were kind of poor, but they were definitely at an important level that I was looking for a liquidity sweep on. So I would have talked about pulling out your swing failure pattern tool here, the sweep level. All right, so you want to see price get above this, swing back under, and then tap it as a rejection, and we saw that happen. So that was your sign to short, right? Potentially, with these 4-hour bear divs that we had talked about, right? You can see lower lows on the RSI, higher or lower highs on the RSI, higher highs on price. Went ahead, rejected off that liquidity. But what we see right now is that we actually swung through that. So if we were to pull fibs swing high, swing low, you're going to want to watch the golden pocket. This is the level you need to hold if you are a bear in the market, right? If you took this short, you're consistently pulling your fibs, and you're looking for this to be rejected consistently. And you can see we swung up into it. We did reject initially, but the fact that we actually pixeled up above the 786 could be a sign that maybe all of this gets grabbed. So we'll see how this does play out, right? We can see here that we got back above 382. So we're going to do some fibception here on the chart. This is something I love to do, where you pull swing high, swing low, and then you pull swing low, swing high, and you can get both your levels, right? So the golden pocket to the downside is around where that 382 is. And you can see we have now accepted above this as support. So on the super short-term time frames, this is something I like to see if you want to get super aggressive with looking at the charts, just kind of understanding what we're doing, right? These levels aren't super important because they are just fib levels, right? They're just mathematical levels, but it's a nice thing to look at to kind of understand how price is moving. If you're sitting above the golden pocket, then you're bullish. If you're sitting below the golden pocket, you're bearish. If you go golden pocket to golden pocket, you're 50-50. If you go golden pocket to below golden pocket, well, you're bearish. So, it's just something nice we can actually get a glimpse of exactly what price is going to do. So right now, very 50-50, but as soon as this moves up or below these fibs, we will know what's going to happen. And we actually have this yellow line here. What is that? That's actually the daily open. So we have another line right in the middle of these two that will signal for bullish or bearish. Getting above or below this. Would I trade off any of this stuff? No, don't trade off of any of these levels. This is just something to watch on stream because I know people like the short-term price action. Everyone's got short attention spans. So here's some 1-minute TA we will keep up on the trading view chart for now at least, because volatility is fun to watch for sure. We go back over here to trading light. You can see open interest is coming up. So open interest means that positions are opening or closing. So this coming up means the positions are opening. We go over here and look at CVD. CVD going down means that those positions opening are shorts. CVD going up means it's long. So we see a lot of shorts actually being opened. You can see right here, after we had this big move and this rejection, a lot of shorts are starting to open in the market. A lot of shorts got filled with these walls. So if we can get above this high, you're going to be trapping those shorts as long as they do not close out. So the best thing we can see right now on price is for price to come up, to get above this high, for that to accept as support, and for open interest, it doesn't even need to accept as support actually, but we just need to see open interest not decrease. As long as open interest either continues up and CVD continues down or just stays flat, then that signals that all of these shorts are going to be trapped. If we see open interest come up with CVD and we see this move, then that means that a lot of longs are top longing. So a lot of different ways to interpret this. Not really much we can do to predict it other than just sit back and react to price action and understand how levels are working right now. This high should be good. If we can get above this, then you're going to be trapping all those shorts. And I say all those shorts, there's really not too many shorts, but definitely more shorts than longs being opened in the market, at least over here on Binance. We go over to Bybit though, and you can see on the Bybit futures pair, more longs are starting to open, but nothing too unhealthy. They've continually been opening longs kind of steadily throughout here. Not a ton of volume in the order flow. We go over, turn on the volume. Fairly low volume. Definitely higher volume on this spike, and then we really just have seen a lot of low volume here on the chart, so I guess there's a lot more volume today than there has been, but overall, nothing too crazy when it comes to the order flow. People really should not be trading today, so I think that's a big reason why. Got just 10 minutes until the meeting. Let me know any questions you guys got in the chat below. Only do these streams like once a month. Pretty much just seems like we do them whenever the Fed does have a meeting, which I think is nice. I can get to talk to you guys, answer any of your questions, so make sure to let me know. We will probably be going on for about another hour. We're going to watch the meeting together, and then I'll wrap it up after that. I'm not trying to stay here for too long. You do see Bitcoin rejecting off another sell wall. This one's only 350 Bitcoin, but definitely a reject in there. We could probably not get above the golden pocket. You can see right now, we pulled these fibs to get the fib section going on. We'll remove that bottom swing high, low to swing high. We can see we're right within these fibs, so let's see how this reacts. Is this going to reject or accept? If we can get above this and start accepting above, boom, you're going for all-time highs. If you can not accept above and you go below, oh, there you go, you're going lower. That's how good these levels work out, right? If we, like, it's really is the 618. If we get above or below this, it will signal where price is going to go, at least probably, right? None of this stuff is guaranteed, but the probabilities say, I've watched this stuff fractal enough on the charts, and yeah, that's how these fibs work. So let's see how it does react here. Of course, you're not trading just off fibs. It's just something we can do to understand how price is reacting mathematically. Appreciate all your help, man. Losing Money Daily says, seriously, I look forward to your updates. Ironic name. Hopefully you're making money daily. Appreciate you, though. Let's see how price reacts here. 1 minute time frame, kind of terrible to look at. We'll stay to the 5 minute. That'll be better. We want to see these 5 minute candle closes, hourly candle closes, right? We got quite a bit of time left on this hourly candle close. Let's see if we can get above this right here. If we can close the hourly above this wick here at around 60,750, that's what I want to see, or close the hour at least above this golden pocket. That's what I want to see. So far, we are right in the deciding zone. What is it going to do? We don't know. Let me go ahead and move this back over here. Get the stream ready for the meeting, because that will be pretty interesting to watch for sure. Thought I had this up, but I guess not. Guess it got closed out. Could see rejection that golden pocket initially. Alright, cool. I got the Federal Reserve's YouTube channel pulled up on my other monitor, so we'll get that going as soon as that does start. In just 8 minutes now. Should be a pretty boring stream that Jerome Powell is going to put on. But it's important to watch for sure. It's going to affect the markets. The price action will be less boring, I'm assuming. What can we talk about? Well, let's go over to Bitcoin dominance. And we can see dominance here on Bitcoin has continued to go up. So we talked about how this could be this last spike before the true altcoin season. Let me get rid of these indicators below. This last spike up before altcoin season, where we do enter the last phase of the bull market. Usually you have a big altcoin season before the final top does come in. So the fact that we haven't had that yet, we haven't had Bitcoin dominance coming down, could signal that we still got the best part of the bull run ahead of us, right? And when could this happen? Well, I expect it to happen into election season, but who knows? Maybe the 4-year cycle does play out. I will be willing to change my thesis. It all depends what the S&P does. So if the S&P can continue into all-time highs here, that will probably give us that boost of euphoria, and rotations will be made out of this thing into risk on assets such as the Russell 2K. And we do see the Russell is through the point of control. So this is something that's really awesome to see. We've been watching these volume levels here, point of control, value area high, value area low of our previous bull market range back in 2020, and these levels have been respected very well. We initially rejected value area high, came all the way down, bounced off point of control of the bear market range, right? So this kind of bear market range within there, came all the way back up to test point of control, rejected that of the bull market range, and then fell back down, bounced off the value area high of the bear market range, and then now we're coming back up, and we're through the value area low and point of control. The more times you test the level, the more likely it is to break. So if we come up and test this value area high, the more likely it is to break. And if we can break that, we can turn it into support, and that could be very, very bullish for the altcoin market. The Russell is correlated with the altcoin market as well as Bitcoin pretty well. So this going into all-time highs would be pretty insane. That would send a lot of stuff to the moon, in my opinion. And really, that's not an opinion. If the Russell goes parabolic, you're going to see a lot of stuff go to the moon. The lower cap stocks are definitely correlated with crypto. All right, but just let's see here. Pistachio says, unfortunately, these live streams always seem to be quiet. I've always maxed out the volume whenever I tune into one. Okay. I don't know if you're talking about Jerome Powell speak or me speaking, but yeah, I'm gonna assume it's me. I'm gonna go to 130% here on the mic. Hopefully that makes it louder. My mic is just super quiet. I don't know how to fix it. It's like whenever I talk to people on Discord, it's quiet. I gotta figure that one out. Whenever I edit my videos, I'm always turning it up like 15 decibels. But I did just turn it to 130% here on OBS. So hopefully that actually did turn it up for you guys. If not, I can put on a filter to up the gain on it as well. And I'll actually do that right now. I'm gonna up this like 5 decibels on the gain. So hopefully, guys, this isn't too loud, but I did just up the mic volume quite a bit. Hopefully, that's noticeable. It's better. Cool. Okay. Awesome. 0.5 confirmed. Yes, that is confirmed. They did cut by 50 basis points. The federal funds rate is now at 5% versus the 5.5% it has been for quite some time. Is this bullish? I think it could be short-term bullish for sure. It really depends what unemployment does, though, and the fact the more they cut, the more they're worried about unemployment. So if unemployment truly does continue to come up more violently, right, we see unemployment right now has actually ticked down from last month's reading. So if we see unemployment continue to come down while they cut like this, then that's bullish, right? We want them cutting. We don't need their high interest rates, but if they're doing it because unemployment's skyrocketing, then that is definitely bearish. So I would say, just at a glance, since they're cutting more, it probably shows that we're in a bit of a weaker economy, and yes, that is more bearish. But we're going into election season, so I think short-term bullish potentially, so that they can, they're trying to boost the economy for the elections. I think a lot of this is going to get front-run. If they are doing an aggressive hiking or cutting cycle, we could see market participants start pumping up price soon, and then when they actually continue their cutting cycle and the rates get lower, then that's where you actually see the depression kind of happen as unemployment continues up here. So we'll see. My base case still remains the same. If you guys have been following the channel, I think we're going to have a bit of a rally into October, November. Whenever the president gets elected, that's where the top kind of comes in, because people are going to be super bullish. Let's say Trump gets elected. Everybody thinks that he's going to make the economy great again. And I do think, while he might be decent for the economy, he's really good when it comes to foreign relations, right? That's the best thing we can have Trump in office for, is for foreign relations. But when it comes to the economy, even though he's a good businessman, he ain't going to change anything. That stuff is all controlled by the Fed and other agencies that he really doesn't have a hand in. And he can just pass bills or just veto bills, and he's not going to be able to do much. If we're going to enter a recession, we're going to enter a recession. Let me get to some of these more of these chats. What about the thought that most of retail gambled their money away on sold meme coins? They do this every cycle, yeah. But I think that, people gambling on meme coins didn't really have much money in the first place. If there's big money that's really moving price, they're not going to be gambling on big meme coins, right? Big, retail. Like, retail doesn't necessarily mean it's small money. There's a lot of retail that's still out of the market right now that's going to come in. A lot of older guys that they're not going to buy meme coins. They're going to buy your bigger altcoins, stuff like Tau, Caspa, some of those newer ones, those that haven't had speculation in previous bull runs that have tech like AI or layer one fundamentals, those will get pumped. And when you see altcoins getting pumped, that money will then rotate out into meme coins, right? It's the degens that have been in since 2023, invested in these altcoins and, better meme coins as well, that when these older guys come in and pump our bags, we rotate out and we're the ones that are buying the meme coins back again, pumping those. That's usually how it goes. Jerome Powell reduced rates by 50 basis point to 4.8% on their Fed cut, likely in December. Yeah, I could definitely see another rate cut in December, right? Normally when they start these rate cuts, it's cycles. So now that they've started the cutting cycle, we should see continuous cuts from here on out. Maybe a few pauses here and there, but it's going to be a cutting cycle for sure. Better, cool. Glad that my mic is sounding better. Did they say that about rate cuts yet? They will be talking about rate cuts right now, actually. So we got like 1 minute left until he does come on. Oh, looks like he's actually coming on early. Okay, hold up. Let's get this over here. Hold up. We got the Fed speaking. Let me set this up for you guys. We'll just do that. That should work.
Growth of consumer spending has remained resilient, and investment in equipment and intangibles
I just realized you
has
guys
picked
couldn't
up
hear that stuff
from
originally.
its
Sorry about
anemic
that.
pace last year.
He hasn't said much.
In the housing sector,
Same stuff
investment
so
fell
far.
back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year.
Just trying to get this set up properly.
In our summary of economic
Sorry about
projections,
this.
committee participants generally expect
Okay.
GDP growth to remain solid, with a median projection of 2%
Dollars dumping.
over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed.
All right, just turned it up. Got
Overall,
everything set
a
up.
broad set
Sorry, I
of
kind of panicked
indicators
there
suggest
because
that
I think my
conditions in the
time's
labor
behind by
market
like
are
1
now
minute on
less
my
tight
computer,
than just
so
before the pandemic
He's a
in
little faster than I
2019.
thought, but audio should
The
be
labor
good.
market
Just
is
let me
not
know.
a source of elevated inflationary pressures.
Good now. Cool.
The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June.
Only above that golden bucket now.
Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%.
Spiritual will
This
says can't hear.
recalibration of our policy stance will
be able
help
to hear this.
maintain
Let me
the strength of
actually-
the
let me check this
economy
on my
and the
phone.
labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will
Okay,
continue to
just
make our
checked. You
decisions
should be able to hear that.
meeting by
So
meeting.
that's something on your end.
We
Sorry.
know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher
Chinese says he
unemployment,
cut before going
as
to
well
under
as the changed balance
2%.
of risks.
Yeah, he's worried about
These
unemployment.
projections, however, are not a
Emilio.
committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So Okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the 2 employment reports, July and August. We've also had 2 inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make the, sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks.
Harlem, it was a 50 basis point cut.
You'll see
they announced that 30 minutes ago, so that already came out.
It's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. Again, I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members, rather, of the committee are thinking today, assuming that their particular forecasts are realized.
Go to Chris.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%, and inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment, moving to a more sustainable level. So that the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, you know, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year? For
Yeah,
example?
we're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do
sovereign, I
this.
agree.
We
It's
made
pretty
a good,
painful.
strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, you know, make a good, strong start.
Harlem,
but,
I can't say if price go down or up,
and I'm
but
very
we will
pleased
talk
that we
about the
did.
price
To me, the
action after
logic
this
of this,
meeting.
both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina.
Hi, Chair Powell. Gina Smilek of the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in a solid condition, and our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick.
I don't know if I'd agree with that one.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions in there, but so I would say we don't think we're behind. We do not think we think this is timely, but I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably under 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby?
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And, but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. By many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, the retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So that's, our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
To it. I think it's all just pre-programmed. Chinese Remilio.
Michael McKee with Bloomberg
I agree.
TV and
One less
radio.
bump and then great pressure.
To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if, as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So, and policy, we think, is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment, and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're right.
It is low.
Adjusted
Every time
for
it starts this
demographics,
trend
for
up,
aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be, their wage increases rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person. As measured, it's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, that could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months. And, so what we say is,
This is when they started cutting in
as the
2007.
risks, the upside risks to inflation have really come
They
down.
are late to the party
The downside
again.
risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good
Doesn't
position
necessarily mean it's all
to
over right
manage
now, though.
the
We'll get
risks
into it.
to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. Or no, on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I mean, I think we are it's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now, some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, you mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So there was people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me, and
We're going to
that
find out
the
when we
neutral
enter
rate
depression and
is
have
probably
to do it.
significantly higher than it was back then. How high is it? I just don't think we know. It's again, we only know it by its works.
And one more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so this is my fourth presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group, and then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed, and I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind, and it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
I actually agree with him there. I don't think he's doing it because of the elections. If he would have done it sooner, because
Thank
it
you,
does have a massive
Chair
lag
Powell.
effect.
I'm Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually
Gonna
large
buy
rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that.
Or
Listening to
Amelia
you talk about
retracted his
inflation
message. I saw
moving
that.
meaningfully down
The
to
news
2%,
what?
is the
I'm
Federal
very
Reserve
curious about that as
effectively
well.
declaring
How
a decisive
the
victory
DXY
over
react here?
inflation and rising
I
prices?
guess you removed it because we got
No.
a swing failure on that. It
We're
does
not.
look a little bit
So
bullish,
inflation,
but do you think the dollar is in our
what we
favor?
say is we
All
want
these
inflation,
tapped
the goal
lows.
is to have inflation move down
If you go
to
lower
2%
here,
on a
something
sustainable
I'd like to
basis.
see.
And,
Still
we're not
showing
really,
weakness.
we're close,
But,
but we're not
yeah,
really
we
at
have a bullish
2%.
swing fail on
And
the
I think we're
dollar
going to want to see
potentially.
it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels, but they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, you know, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this, but, you know, the direction of travel is clear, and as long as market rents remain, you know, relatively low inflation, over time that will show up. Just the time it's taking now, several years rather than just 1 or 2 cycles of annual lease renewals. So that's, I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. You know, they all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. You know, what's the likelihood of that, and how would you react to that?
So the housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not, you know, obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to find, to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And, you know, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And, I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
Hi, Victoria Guida with Politico. Just following up on some of the labor market talk earlier, you know, monetary policy operates with long and variable lags, and I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, you know, business people who are actually out there doing business. So I think, you know, I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, you know, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but, you know, we might well have. I think that's not, you know.
This is the level you
that
want to
doesn't
close above on the hourly.
Really answer the question
Right now
that we
doesn't
ask
matter 'cause
ourselves,
hours
which is
over.
let's look, you know, at this meeting, we're looking back to the July employment report, the August employment report, the 2 CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? We knew, it's clear that we literally, everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Elizabeth. Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well, what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on, and I think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices as opposed to high inflation, and we understand that's painful.
Greg.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, could you talk, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? After the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Matt Egan?
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
Let me we'll give you the second question. So, the answer to your question is that yes, those changes were negotiated between the agencies with my support and with my involvement. With the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them.
Recession,
so,
2007,
yes, that is,
September, it's pre-programmed.
That's happening with my support.
It's interesting, right?
That's not a final proposal, though, you understand. We're putting them out for
time.
comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately.
2008, identically.
I don't know
Except
exactly where that is.
I don't think the housing market's going to be
The idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
Right. And then yesterday there were merger reform finalizations from the other bank regulators. Well, what does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage, so very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Is the economy more vulnerable to a shock now that could tip it into recession?
I don't think so. I don't. As I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels.
I don't know what charts he's looking at. There's a lot of recessionary indicators flashing.
Thank you.
Thank you.
A lot of leading recessionary indicators flashing, which is what you should be looking at, right? I guess they don't look at the leading recessionary indicators, and that's why they're always behind. But I don't think that's anything too concerning. Let me actually hold up. Let's get the view back to. Hope you guys all made it through that. Pat yourself on the back. That was painful to watch for sure. I felt like I was in a college lecture or something. But let me go back to the main screen here. Get that going on. And then let's talk about some of what he said. I can also put some music in the background. We can turn that back on. Alright, so basically, he didn't tell us a whole lot, but we can kind of understand that he thinks that unemployment's not really a problem, when historically, if we go over to the chart here, also, by the way, just looking at the levels real quick, clearly we're at a big point of resistance right now. There's a lot of sellers in the order books, lots of sellers up here. I would expect, this is kind of where I expect it to come, all the way down here. So we'll see if this does in fact play out, right? Initial move, the fake move, then we come down, and then everybody gets real bearish, and we pop back up and then go. I do still, like, my base case is still the same. I think we're going to have a larger pump, like sustain for a couple months before the final top does come in, and then we enter a recession, maybe even depression. I think it's going to be pretty bad going forward, depending on what unemployment does, and that's the big thing, right? So unemployment, historically, every time this starts to trend up, it doesn't stop until you get to like 10%. So the fact that we're coming up this fast, I don't know what he's waffling about in that speech, saying that there's nothing to worry about when it comes to unemployment, because this is very concerning. Yes, we're at a low level. 4.2% is historically very low when it comes to the unemployment rate, but also historically, every time this starts to trend up, it does not just stop at 4.2%. It goes all the way up to around 10%. Maybe you could say 6%, but even 6%, that's enough to have your collapse after the dot-com bubble. And you can see this big spike here. You shouldn't wonder what that is. That's COVID, obviously. But we know that the economy can, if the economy is able to survive 15% unemployment, 10% unemployment, then yeah, 4.2%, it's not anything that's signaling a recession is imminent, but this is a leading recessionary indicator. Whenever you see this thing starting to trend up, yeah, we might not be in a recession right now. Might not be in one in a couple months, but give it a year, and we're going to be up here somewhere. So I think they're late to the party again, because in 2007, they started cutting right here, right after it started coming up. They started cutting after it started trending up. That was too late. It lagged for too long, and then you had this happen. You could argue the cuts don't really have an effect, and the labor market's just going to do what the labor market does, and it has its own cycles. And I probably agree with that more. Do the cuts really matter that much? I think it slightly does, right? Especially new business trying to take out loans. It's going to help unemployment, but at the end of the day, yeah, it could just be cycles, right? We have cycles and everything, so we'll see what does play out here. We just want to see unemployment continue to trend down. And then, yeah, of course, it can go up later on. But if my base case is to come true, then we want it to trend down a little bit. We want this euphoria in the markets. A lot of the stuff is pre-programmed. Big, wealthy people, big hedge funds, whales, people that fund politicians, they love this stuff. They love the boom and bust cycles. They want a recession because they buy in the recession. And I mean, as people, as investors, as traders, we got to just play the game, right? That's how you make money in the markets. If the markets were just consistently flat and healthy, there wouldn't be much money to make. If I was in control of the Fed, I'd keep everything pretty stable and the markets wouldn't move a whole lot, right? It'd be more like gold. It'd be more healthy. But people that have a lot of money to move in the markets want a lot of volatility, right? You got to have volatility to be able to make money, right? Someone's got to lose for there to be winners. So you got to have these recessions and depressions, and I think that's pre-programmed. I think they want unemployment to trend up. They want a big recession to happen so they can buy back and then have the cycle repeat where they just buy and sell, the economy essentially in these boom and bust cycles. And I think it is a pre-programmed demolishment that is going on. Demolition, not demolishment. But yeah, it's a controlled demolition of the economy right now. But we're going into election season. I think they're going to hold it up for election season. What would be real funny, if you want to get real conspiracy theory here, is Trump's going to win, right? The economy is going to be booming into that election, right? The charts are going to be booming. We're going to have everything going parabolic into the election. Trump's going to get elected. Everybody's going to go, oh my gosh, Trump's elected. The economy is going to be booming. He's going to bring America back, and we're going to go into this mega bull market because Trump's elected. But they've already pre-programmed the demolition, and that's where they send us into a depression, and they blame it all on Trump. I don't want to get political, though. Actually, I'm actually fine getting political. I don't really care. A lot of people try to stay away from that kind of stuff. I'm fine. I don't really like Trump that much, but I think that he's way better than Kamala. It's not really debatable, but I would love to debate it in the comments if you guys disagree. The SOM rule. Remilio, you're absolutely correct. Go to the SOM rule. Like this, if this doesn't tell you a recession's coming, I don't know what does. I don't know what Jerome Powell's looking at when he says nothing shows us that a recession is coming. Like, look at the SOM rule. This thing's been almost 100% accurate predicting our last recessions, and you can see it's crossing these EMAs. This is signals recession for sure. Big recessionary indicator, leading one. Let's see what else we got in the comments down there. It's all a simulation. Yep, basically. Volume is too low. Yeah, definitely low. Like it's more volume than we've had the past week or so, but I mean, we've just had so low volume, like this entire month really on Bitcoin. Really, this entire summer, right? There hasn't been much volume since the spring. Super low volume. And what's interesting is actually in the bear market, we had a lot more traders in the market than now. Don't know what that really tells us, but yeah, definitely some low volume. No one here to get Bitcoin higher. We will just keep rejecting. It depends. Bitcoin's a complete wild card. We've heard politicians say they're going to make it a reserve currency for the U.S. dollar, similar to gold. Other countries have instituted it as the legal tender. There's a lot of fundamentals of Bitcoin that make it kind of the best asset on the planet. It has fundamentals to send it to multiple dozens of trillions of dollars in market cap. It's not out of the question. I think there's a lot of big catalysts for big money to step in. We just don't know, is big money really going to step in or not? So that's, it's a wild card, right? Retail isn't going to be able to move it much at its market cap. Retail is going to move the altcoins, so big money's got to step in to buy Bitcoin, and then when Bitcoin pumps, then yeah, retail is going to buy the altcoins. That's exactly what I've been telling people. If Trump wins, dump it on his head and blame him. Yep, that's something I've been thinking for quite some time. So are we going to skyrocket? No one knows. So far the charts are good, right? So I have these two kind of levels put out: resistance, support. And then I have this fib, swing high, swing low, very, very locally. We go over here to the 5-minute time frame. We want to see if this golden pocket can hold or if it rejects. I think overall, though, we jump over here. We had the dollar and S&P pulled up on my other screen. You can see the S&P actually made a new all-time high. It swung failed to all-time high, but the fact that it was able to pierce this is pretty good, and we're showing some strength at this level. Pixel touched that 236 once again on this. Could come down a bit lower. We got support lower, but so far higher lows, higher highs. I like what I'm seeing on the S&P, and then the dollar. We broke into a new low, but all of this, it was a swing failure, right? So swing failures are usually bullish when they happen at the lows, bearish at the highs. So we had a swing failure of the highs on the S&P, technically bearish. Swing failure of the lows on the dollar, a big swing failure, by the way. That's technically bullish. So we'll be watching this stuff closely. It only gets confirmed when you make a higher high or a lower low. So if we see a lower low on the S&P, then we got to watch this golden pocket, right? Whenever you make that lower low, you got to watch swing high, swing low, and you got to see if we reject or if we can accept. All right, so that'll be the deciding point. We don't really decide what's going to happen today. Today is just the data, and then the market's got to digest the data as we go on. They're going to decide, do we really have to worry about unemployment, or are we good to go? So we'll see what happens here. We give it some time to cook. We got, just a couple more days left on this week, and I think next week, by the end of that week, we'll know much more about, giving off price action, what's going to happen. Price action can tell the news a lot of the times. But yes, so far we want to see, are we going to actually make these higher highs on the dollar? And if we do, are we going to hold the golden pocket, or are we going to lose the golden pocket to the downside or upside, depending on what chart you're looking at? But so far, the fact we are able to pierce this stuff, it's not the worst thing in the world, especially on a news event like today, because normally when you have a swing failure, right, it grabs all the liquidity and there's none made up here, but because it's happened on a much higher volume day, you're probably building a lot of liquidity up here, right? There's probably more stuff to get grabbed above that high. So I don't mind swing failures on news days. Usually that stuff gets grabbed anyway. But we'll see what happens. I think overall, I'm still very bullish. I'm not selling anything because I think we're going to go into a recession. I think we're going into a recession. I think it's going to be 2025, not necessarily this year. But the top could come in sooner rather than later, right? So I have this big box here for a reason. This is my first conservative, let's get cautious, let's plan to get out level, and potentially it could be over. We could be entering a recession now. I'm a bit more optimistic, though. I think we're getting up here. I think there's going to be more retail euphoria. I'm seeing a lot of bears in the market right now, and we all know election season should be pretty bullish, and stuff happens fast in crypto. Like you look at Total 3, look at the parabola that happened in 2020. I mean, people think this stuff takes years. It doesn't. Like from the start of this to the first peak, that was 72 days, barely 2 months, and you've done, what is this? 400% on Total 3. So, I mean, if you're talking just 2 months, 400%, we go over here on Total 3. Let's go 200% because, diminishing returns, you're well above all-time highs on Total 3, a $1.6 trillion market cap. Something like this in the next 72 days. Like, that's what you'd be looking at right there. That is possible. That is absolutely possible to happen. And this would be half of the returns you had last cycle. So, yeah, I mean, don't rule this out at all, right? Do I think it's going to be this crazy? No, I'm a bit more conservative. I would go like swing failure of the highs or even value area highs. But I can't get bearish right now, right? Structure we're forming is very bullish. It's kind of Wyckoff, like massive macro Wyckoff, especially over on others. So look at the others. This is some lower cap stuff. You see, if we go here to remove all the indicators and then jump over to, let's do the weekly time frame. You see you have consolidation, breakout, backtest, go. So, a bit of Wyckoff accumulation there potentially. And I think it is shaping up pretty well, right? You had a swing failure of these lows, tested bottom side of the, or top side of the bear market range. I mean, it looks set up to go. The altcoin market looks very, very good. Fractaling stuff that you get before super cycles. But I guess it wouldn't be technically a super cycle. It'd just be like a normal cycle. But these cycles are quick, right? We look at last time this thing pumped back in 2020. You can see from low to first peak, 150 days, and it did, what was this? 140 days, 1,200% over on the others chart. So I think we could see something similar, right, for the next 60 to 90 days. But I don't think it'll be that drastic. I don't think we're going 1,200%, but definitely could do like a, let's just say 200% here. 200% there would get us above all-time highs. And the next 140 days, where does that actually land us? February 2025. So we'll see. We'll see if we get out to February. I think, early 2025 could be where the top comes in. Either that or late 2024. Or the top's already in, right? Anything is possible, but I'm still pretty optimistic. I think if we do fractal 2008, we will still have another high. But we just got to make sure we're getting above this stuff convincingly, right? We don't want to just swing fail the highs on the S&P and then roll over. I like what the Russell's telling us, though, and I like what the altcoins are telling us, right? The risk on assets are looking really, really good right now. It's just your larger cap stuff that's a little bit sus, right? The swing fail on the highs, Bitcoin just showing some weakness. But overall, I mean, I think we're set up for a pretty big rally here, assuming we can hold. And we don't need to hold like where we are right now. We can come down to the 56.6. That's fine. That's actually kind of expected to happen. Or even all the way down to the CME gap. We've been talking about this like CME gap. Still haven't filled this all the way down at like $52,000. So I would not be surprised to come all the way down, swing that, and then we go, right? Scare everybody out of the market once again. That would make a lot of sense. Let me go ahead and read the chat real quick, though. What do you think about gold price in the future? I'm bullish. I'm bullish on gold. But if we do have a recession or a downturn in the markets, gold will go down too. It just won't go down as much, and it'll be the first one to recover. We look back over at the United States interest rates, and historically, like we look at 2008 when they cut, we see gold rally pretty freaking hard. Harder than the S&P and the, well, I guess Bitcoin didn't exist, but we would expect gold to rally harder than the S&P and Bitcoin, which it kind of already has started to do. So this could be a warning sign that the recession's coming or already here. So you see gold rally initially the hardest, and then when it comes into the corrective phase, yes, gold pulls back, but you can see it pulls back much less than the S&P 500, and it is the first one to rally. You see the lows made there versus the S&P, the lows made there. So, we'd see gold, continue the trend up much quicker, and then it makes its high faster. So gold overall does very well in recessionary times. Will Bitcoin follow gold? Who knows? It definitely could. We'll have to wait and see on that one. But you can see this has ticked down. So the cutting cycle has started. Now at 5%. We'll see. I mean, previously when this has happened, that's your S&P. So we'll see if it does this or if it just does this. I'm hoping for this. I think this is probable, but we'll see. Gold all-time high today. I'm sure, yeah. Let's go back over to gold. Yeah, gold all-time high, S&P all-time high. Unfortunately, Bitcoin did not make an all-time high, but the dollar did make a, not all-time low, but it did break the new yearly lows, so that's good, I guess. But it is a bullish swing failure, so we got to keep our eye on this. But yeah, gold showing a lot of strength, but now it's dumping pretty hard. I don't know. I mean, we have a lot of recessionary signs flashing for sure. The Fed is late to cutting again, so we're in dangerous territory for sure. If you look back at my videos from like the beginning of 2024, I had been saying the market's going to top whenever they cut. The market's going to top whenever the ETH ETF comes out. So I'd been warning about this stuff, but we just didn't see yeah, we didn't see the confluences on the actual market that I was looking for. I mean, I guess we did see celebrity meme coins. We saw a lot of warning signs, I'm not going to lie. I was just looking for a bit more structural edge on Bitcoin, like an upthrust after distribution. I was looking for a bit more confluence on the altcoin market. But yeah, I mean, you look at something like others. That's golden pocket retracement. You look at total 3. I think this is also a golden pocket retracement. Right. We just had retracements in altcoins. We had Bitcoin, just barely break all-time highs to get everybody euphoric. Lots of warning signs on the chart. Lots of things to say. It is already over. But I think a lot of people are already thinking that, and we got a lot of bears in the market, and we're going to have a secondary fake out to the upside. Another upthrust after distribution, short squeeze, whatever you want to call it. Especially, with the S&P showing a lot of strength right now. We'll see what happens, though. We got to see the S&P actually convincingly break into all-time highs. Are we actually ever going to have this bull run? Yeah, that's why you got to buy in the bear market. We did already have a bull run, but a lot of those gains have been retraced, right? So, from 2023, you look at Bitcoin, we're still up from the lows. We're still up 280%, right? So that's why it's so important to buy down here and not here. I think most people bought up here. Make sure we're buying when there's blood in the streets down at this level here. When everybody's calling for lower prices, like right here, this is where your altcoins were actually at the lowest point. Everyone was calling for this, and you didn't get it. You got to buy in when stuff is low and everybody's calling for lower. But are we going to get the bull run? I think so. I think we can still get it. At least for the altcoin market. I think Bitcoin's kind of cooked. I think we're going to probably do something like this arbitrarily, right? As I've been saying, distribution sort of thing. Like that, upthrust after distribution. But it is, this thing is really top heavy. So we got to see a higher high here. That'll be the big thing, right? Can we get above these highs at 65K? If we can do something like this, then I think we're good to go. We're good to go for all-time highs. But we need to see structure change here. We need the higher highs, right? We cannot just continue these higher lows. We need the higher highs, and we need this wick to hold. So we need to hold structure. So far, not enough data. We just got to let it play out over the next couple weeks. Are we going to hit 100K? It's possible. I think if they did hit 100K, it'd be like a swing failure. So it would be something to get everyone super euphoric, right? Well, we finally hit 100K. Everybody's calling for 120, 130 or more. And then that's where the top does come in. I'd say that's the top range of my conservative targets, right? So I think we're either going to come up here, distribute, pierce 100K, and then come down as like that's the top end of what I'm thinking as this like upthrust after distribution, or we're going to just blow everybody away and melt faces, and it's going to be a reserve asset, and we're going to like 500K. It's going to be one or the other. I don't think, because I think a lot of people are calling for 120, 130, 150, 200K. I think it's not going to be that. I think it'll be either, I'm honestly thinking like not even 80K, like 78K, right? 78, maybe 80K, and that's where the top comes in. Maybe we do something in between. We go like 95K, get everybody, hooked on that 100K idea, and then we don't hit it. Or we're going to like 500K. One of those like 3. I don't know. I made a video based on my predictions for what we could see on Bitcoin, and that hasn't actually changed at all. So let me go ahead and I can pull that up for you guys, so you can see just kind of what I'm talking about. If you go onto my channel and then scroll down, you're going to probably be scrolling down for quite some time. We will see if we can find it. Probably not going to be able to find it because it was so long ago, but we'll see. It would have been, there it is. Where will Bitcoin top? And you can see these are the levels, right? So I don't know why it's at 40p. Let me get that better. You can see here, either top is already in, Wyckoff upthrust after distribution, swing fail 100K, or the 150K plus blow off top. These are the levels. They still remain the same here. And we'll see what happens, right? But yeah, you can go watch that video if you want. This is from 3 months ago. Bitcoin will top when this happens. Let me get back to the music. Oh, let's see what else you guys are saying down here. Maybe in 2 to 3 years. Yeah, I mean, I would say probably not going to hit 100K this cycle. But that's just, I guess, right? We do not know at all. We'll see. Never knew you'd done live for this, or I would have been here for the FOMC. Don't worry, you didn't miss much. Just the most boring man talking in the world. We did cut by 50 basis points, which was higher than a lot of people expected. It was what CME expected, though. And it does signal that they're worried about unemployment, but he didn't want to say they were worried about unemployment, so we'll see what happens. We'll see what that actually does, right? Unemployment rate is still the biggest thing on the chart. We got to see what these numbers say in the coming months, and this will signal if we're going to have room to the upside when it comes to our charts. I'm still fairly optimistic, though, especially going into election season, right? I don't think we're just going to collapse going into that. 5.3 theory. Yeah, that's like the law of diminishing returns. The Bitcoin's probably going to what, $80,000 to $90,000. I think it's like 85,000, something like that. Definitely think so. Yeah, that's right within my range. But yeah, I don't want to stay on here for too long because I am going to upload this as a video to my actual YouTube channel for the day. I'm not going to make another video today, so I want to make sure it's to the point. I think we covered most of the important stuff, right? We got the levels marked out, resistance, support. You know, if we do fall below this, it's not necessarily the end of the world. It's not no man's land down here. We'd be looking over here for single prints. We got single prints down a little bit lower as well. Let's jump out here to the 30-minute time frame and let this load in here. Let's go over some of this stuff. So we had some untapped single prints, I thought, somewhere on the chart. Maybe all the way back here. Let's see. I guess we don't. Maybe it's on the hourly. Let's see. Might have already grabbed them all. We got sweep levels to the downside, though. Okay, yes, we already grabbed them all. So, yeah, we actually grabbed all the inefficiencies to the downside. But 52.5, we didn't really pierce it, right? We just kind of pixel touched it. So that's the point we could see a sweep of. And then also, this one whale at 47K, he hasn't removed his orders forever. Thousands of Bitcoin just left in the order books. I think that's a potential level. 47K, that's a big point of control. We go over to Bitcoin on the weekly time frame. Pull up your visible range volume profile and zoom all the way back out to 2020. You do see this entire range that we've had throughout the past 2 cycles. We have a big point of control all the way down at 47K. So that's kind of your next target if you do lose this low volume gap right here. And then now actually we're above this higher point of control. So you can see we're holding that very nicely. So I'm actually pretty bullish. I don't think we're going down lower. I think this is going to hold as it has. We're finding some resistance here. We just want to see this kind of box of support hold, box of volume hold. We can chop around in here for a bit, though. That wouldn't surprise me at all, especially after a big news event today. Going to be a lot of positions open that need to get grabbed. So probably some chop here. And then going into next week, the market will decide if it's really bullish or not. Structurally, I think all the charts are saying we're bullish. Although the smaller cap stuff, so the risk on asset stuff, this looks bullish. Bitcoin and S&P 50-50. Russell looks bullish, right? Well, actually, I guess we did swing fail this point of control, so we're testing that right now. We'll see what that comes out to. So actually very 50-50 here now as well. But we do look at the dollar. We're at the lows. Yeah, this is coming up again. Okay, so maybe we're looking a bit more 50-50. We got to let the market digest this stuff. So far, I'm not going to panic over anything I'm seeing, but yeah, look at gold. Sharp rejection there. We got a lot of signs that a recession is imminent. I just don't think they're going to let it happen quite yet. I think there's going to be a lot of shorts that are opened in the market. If we actually check that right now, you can see shorts are being opened over here on Bybit. Lots of shorts being opened over here. Binance as well. What was the rate cut? I missed it. 50 basis points. So, yeah, if we go over here, we'll check that real quickly again. Go over to the Forex Factory. You can see it was 5.5%. It is now 5%. It came in below expectations on here, but they actually did predict this over here on CME. You can see they did predict it. And let's see what they say for November now. I'm sure they don't have this up to date yet, but they do expect only 25 basis point rate cut for November, so that's fine. It really just depends what unemployment does. If unemployment continues to come down, then that's good. If this continues to trend up, then yeah, we're entering a recession or even depression. So hold on tight, but I would say going into election season, going into the fall, it's not necessarily the time to panic. Usually we see markets get euphoric during this time. We should see some exciting times ahead of us potentially for risk on assets. So we'll just see. There's a lot of fundamentals behind Bitcoin that are still very, very good, and I think it is underpriced. If you guys have any last questions, let me know in the chat real quick, because I am going to be ending this pretty soon here if you don't have any questions. But let me know. Anything I talked about, FOMC related, trading related, just no altcoins. I'm not going to be talking about altcoins because that will take forever. Unless the altcoin market, I'll take questions about the altcoin market, just not your individual $5 million market cap coins. Because you really got to research the fundamentals. You can't just go off charts on those, and it really doesn't matter at the end of the day because it's all just going to follow Bitcoin. But yeah, the dollar, I was hoping we'd show some weakness here, but we have made that higher high on the dollar. So now you're going to be just pulling fibs, right? You're going to be pulling fibs, swing low, swing high, watching can you actually get back under this golden pocket. And if you can, then that's going to be looking awesome. But so far, I mean, this stuff is structurally turning more bearish. Could that have marked the top? Could the Fed rate cut have marked the top for markets? It is possible. I don't know if it'll be that easy for shorts, though. I really don't. We never saw Bitcoin dominance drop. That normally happens at the end of a cycle. All right, this is a big reason I've been thinking the top's not quite in yet, because you normally have Bitcoin dominance fall. So we'll see. Maybe the 4-year cycle guys are right, and the 4-year cycle plays out. Maybe I'm right, and we have this upthrust after distribution. We are seeing this point of control starting to get held here by the Russell. So if you want something to watch in the immediate term, let's just keep your eye on this, right? This point of control here on the Russell, that's sitting at $2,235. And this will impact Bitcoin, the altcoin market. The Russell is actually kind of the most correlated chart when it comes to crypto. That or tech stocks like the NASDAQ. S&P, let's just watch this, right? These lows are pretty bad, so I want to see this get swept. I want to see like that happen, and then we'll be good to go. So we'll see. We got a couple months left until our next president gets elected here in the United States. That's pretty crazy. That's going to impact markets. But yeah, thank you guys all for the messages and all that. Appreciate you guys joining in here, and you all have an awesome day. Looks like no one had any questions, so that's cool. If you do have any questions, though, make sure to join the Discord. The link's in the description down below. I have a VIP Discord, but don't join that. Just join the regular Discord. Join the community. Start chatting in the general. Talk about your TA, all of that. Looks like someone just typed a paragraph, so let me read this out. If the bull flag plays out and goes up, what the pull size is? Yes, if you take the pull size and bring it down to the massive buy zone, 47 days, is that the way bull flags play? Okay, so I don't, like, when it comes to charting patterns and drawing, price targets using the pull as a flags, yeah, I guess technically it's supposed to play out like that. I don't really use that at all. I don't care. I don't care about patterns. Yes, the lines can be respected very well. I think it's based off liquidity. So if we have liquidity sitting at those highs, then it's going to want to grab that liquidity. We pull up the liquidity map here on CoinGlass, and this is why 78K is a big level for me. We'll go to the 6-month time frame. I think if we do break out of this, actually we got to go to the yearly now to the upside, you're looking at grabbing this high liquidity nodes up at around 75 to 80. This saying it goes all the way up to like $90,000. So to be liquidity based, if we break out to the upside here, you're going to be hunting liquidity. If you break out to the downside, you're going to be hunting liquidity. So we do have 47K, 46K. That's high liquidity that could get grabbed. But if you grab that, you might start hunting down a little bit lower. So we want to hold kind of where we are, in my opinion, and then we can start hunting up to grab these all-time highs. So yeah, I think it's more based on liquidity rather than just a pull size, right? But yes, that is technically how it would play out. Yes, if you're just going on the charting pattern, yes, you take the pull from the low of the flag or high of the flag. All right, so yeah, thank you guys all for tuning in. Make sure to join that Discord. First link in the description down below. Check out my exchange partners if you want. I'm partnered with a whole bunch of exchanges, so you got a variety to choose from. Some of them are more trusted than others. Some of them are sketchy, but they've all sent me their proof of reserves, and they've actually partnered with big, like the Jump X, the one I've been promoting recently. I would have never partnered with them because they seemed sketchy, but they sent me the proof of reserves, and they're actually partnered with George at Cryptos R Us, and they're like the main partner for him. He shouts them out, so I'd assume if he's trusting them, I can trust them too. They're giving me a pretty good partnership, so go check them out. Try out their exchange. They actually added a new feature for 1000x leverage. Never use that feature unless you're just trying to have some fun with $1 or something. But yes, they do have that, that's pretty funny that they're the highest leverage exchange now. But yeah, enough of me rambling on. I'm going to be putting this up with the intro edited out and stuff, so if you want to rewatch the stream, feel free to do so. There's some good stuff in here. But with that being said, thank you guys all for tuning in. Thank you guys all for hitting the like button, the subscribe button. The channel is growing pretty quickly. I appreciate all of you for sticking around. And you all have a fantastic rest of your day, rest of your week, and let's hope for some exciting times here in the market. But yeah, thank you guys all for watching. I'll see you all in the next one.